Let me ask you something uncomfortable. What if the smartest financial decision you think you're making is actually the one destroying your wealth? Not because you're uneducated, not because you lack information, but because the very brain that got you this far in life, the one that aced tests, solved problems, climbed ladders, is quietly, systematically wiring you to fail in the market. Here's a number that should stop you cold. The average retail investor, someone just like you, earns roughly 3 to 4% annually over a 20-year period. The S&P 500, it returned over 10% annually during that same window. Same market, same stocks, completely different results. And here's the part nobody tells you. The gap isn't about access. It isn't about tools. It isn't even about intelligence. It's about your brain. And today, we're going to expose exactly what it's doing to you. Problem explanation. Picture this. It's late when every financial news channel is screaming about record highs. Your coworker just made $40,000 flipping crypto in 3 months. Your neighbor refinanced his house to buy Tesla stock.
And you, the careful, rational, smart person, finally decide, okay,
it's time. I'm getting in. You buy. And then it crashes. Sound familiar? Because this isn't a rare story. This is the story. It plays on repeat, decade after decade, generation after generation. The dot-com bubble, the 2008 housing collapse, the 2021 crypto explosion. The pattern never changes. Only the ticker symbols do. And here's what's maddening. You knew the rule. Buy low, sell high. Every single person on earth knows that rule. It's the first thing anyone ever says about investing. But knowing it and doing it are two completely different things. Because the market doesn't just test your knowledge, it tests your nervous system. And most people's nervous systems are not built for this. But here's the part nobody tells you. The problem isn't discipline. It isn't laziness. The problem is that your brain is running ancient software in a modern financial world, and that software has a critical bug. Let's go deep for a second, because this is where it gets dangerous. Your brain has two primary systems at war inside you every time you look at your portfolio. There's the rational, slow-thinking prefrontal cortex, the part that reads books, makes plans, and knows better. And then there's the amygdala, the ancient, emotional, survival-driven part of your brain that reacts to threats and rewards in milliseconds. Here's the brutal truth. When the market is rising, your amygdala floods your body with dopamine, the same chemical released when you eat sugar, when you fall in love, when you win a bet. It feels good to watch your portfolio go up. And that feeling, that chemical reward, is what drives you to buy more. At the top, when prices are highest. And when the market crashes, your amygdala triggers a fear response so powerful it's biologically identical to being chased by a predator. Your heart rate spikes, your palms sweat, your vision narrows, and your one overwhelming instinct becomes, get out.
Sell, escape, survive, so you sell. At the bottom, when prices are lowest,
buy high, sell low. Not because you're stupid, because you're human. Most people never realize this. But a 2024 study published in the Journal of Behavioral Finance found that over 68% of investment decisions in volatile markets were driven not by data or analysis, but by emotional and psychological triggers. 68%. That means the majority of the money moving through markets on any given day is being driven by fear, greed, and something even more sinister, something called herd mentality. And this is where it gets really dangerous. When everyone around you is buying, your brain doesn't just want to follow, it needs to. Because for 200,000 years of human evolution, being separated from the herd meant death. The tribe moved, you moved. The tribe ran, you ran. That instinct kept your ancestors alive. In the stock market, it's bleeding you dry. Real-life examples. Let me show you exactly how this plays out in real life. Not in textbooks, in real money. Real people, real pain. In 1999, at the absolute peak of the dot-com bubble, individual investor inflows into equity mutual funds hit an all-time record. Billions of dollars poured in from everyday Americans who had watched the market climb for 5 straight years and finally couldn't resist. They bought in at the top. Within 2 years, the Nasdaq had lost 78% of its value. Those same investors, panicking, sold near the bottom. They didn't just miss the recovery, they locked in catastrophic losses. Now fast forward to March 2020. COVID hits. The market drops 34% in 33 days, the fastest crash in history. Millions of retail investors panic sold, they got out. And then, within 12 months, the market not only recovered, but hit new all-time highs. The people who sold locked in their losses. The people who held, or better yet, bought more, made fortunes. Same market, same crash, completely opposite outcomes. The only difference was the psychological response. And here's the real gut punch. It wasn't the uneducated investors who panic sold the most. Studies consistently show that high-income, highly educated investors are often the most susceptible to these emotional traps, because they're more confident in their ability to time the market. They believe their intelligence gives them an edge, and that belief is the trap. The hidden mistake, but the real problem is deeper than just panic selling or FOMO buying. There's a hidden mistake that almost nobody talks about, and it's costing you more than any single bad trade ever could. It's called action bias. Your brain is wired to believe that doing something is always better than doing nothing. In most areas of life, that's true. Work harder, get more done. Study more, learn more. Act decisively, win more. But in investing, the data is brutal and clear. The more frequently you trade, the worse your returns. A landmark study by behavioral finance researchers Barber and Odeen found that the most active traders underperformed the market by over 6% annually compared to passive investors who barely touched their portfolios. 6% every year, compounded over decades. Most people never realize this. But your instinct to do something when the market moves is not a strength. It's a liability. Every time you log into your brokerage account during a volatile week, your brain is looking for a reason to act. And action in most cases means selling low or buying high. The market doesn't reward the busiest investor. It rewards the most patient one. And patience is not natural. Patience is a skill you have to consciously build against the grain of your own biology. Actionable shift. So what do you actually do about this? Because knowing the problem is only half the battle. The other half is rewiring your response. Here's the first shift. Stop checking your portfolio every day. I mean it. Research shows that investors who check their portfolios daily are far more likely to make emotional trades than those who review quarterly. Every time you see a red number, your amygdala fires. Every time you see green, dopamine spikes. You are literally training your brain to be reactive. Set a schedule, quarterly reviews, stick to it. The second shift is this. Build a written investment thesis before you buy anything. Not a feeling, not a tip from a podcast. A written, reasoned argument for why you're buying, what price would change your thesis, and what your exit strategy is. When the market moves against you, you go back to that document. You don't go to Twitter. You don't go to Reddit. You go to your own logic, written in a calm moment before the chaos started. And the third shift, and this one is the most powerful, is to automate your investing and make it boring. Dollar cost averaging, automatic monthly contributions. Index funds. Remove the decision from the emotional moment entirely. The greatest investors in history don't win because they feel less fear or greed than you do. They win because they've built systems that make their emotions irrelevant. Warren Buffett didn't build a $100 billion fortune by being smarter than everyone in the room. He built it by being calmer than everyone in the room. And calm is a system, not a personality trait. Here's what I need you to sit with after this video ends. The market is not your enemy. Inflation is not your enemy. Even bad stocks are not your enemy. You are your own worst enemy. And the first step to building real, lasting wealth isn't finding the next hot stock or the perfect entry point. It's understanding the machine running inside your skull and learning to override it. Because every time you panic sell, someone on the other side of that trade is buying your shares at a discount and thanking you for it. Every time you FOMO buy at the top, someone else is quietly selling you their overpriced position and walking away with your money. The game isn't rigged against you because of Wall Street. It's rigged against you because of evolution. And evolution doesn't care about your retirement account. So here's the question I want you to carry with you. The last time the market dropped and you felt that urge to sell, what would your portfolio look like today if you had done nothing? Think about that. And if you think the way your brain handles losses is dangerous, wait until you see what it does when you start winning. Because overconfidence is a whole different kind of trap. And that's exactly what we're breaking down next. Don't miss it.